Hello friends, this is Mirhan Hippolito, a Forex and cryptocurrency expert at Traders Union. Today, we'll dive into an interesting and controversial topic, what cross-trading is and why it's banned on many exchanges. What is cross-trading? Cross-trading occurs when the buying and selling of an asset happens within the same broker or fund, bypassing the open exchange. This method of trading helps reduce costs and avoid sudden price swings. However, as you might understand, there are pitfalls. Example of cross-trading. Suppose a broker has two clients. One wants to sell 1,000 shares and the other wants to buy them. Instead of placing these orders on the exchange, the broker simply matches them within the system. It seems everyone is happy. Minimal costs. The transaction is executed faster. The price remains stable. But here comes the question, how fair is this? Why is cross-trading banned? In many countries, cross-trading is strictly regulated or banned because it can conceal the true market price. It can lead to conflicts of interest. Someone might get a less favorable price. It can enable market manipulation. However, there are exceptions. In institutional investing, such transactions are permitted under strict conditions. For example, if both parties agree in advance and the transaction is carried out at a fair market price. What do you think? Is cross-trading a useful tool or a dangerous scheme? Share your opinion in the comments. Don't forget to subscribe to the channel and hit the like button if you enjoy analyses on such topics. See you in the next episode.